Some people don't lose money in markets by accident. They lose it the same way people return to toxic relationships, because something inside them recognizes the chaos, the anticipation, the surge, the panic, the hope of redemption. Financial markets are one of the few places where emotional turbulence can disguise itself as intelligence. So what looks like analysis is sometimes just a nervous system searching for stimulation. And the strange part is this: many people feel more alive during a market crash than during years of steady growth. Because calm success is quiet, but chaos gives the brain something it secretly craves: drama. And once money becomes a source of emotional drama, people stop using markets to build wealth. They start using them to feel something. You probably think bad financial decisions come from ignorance. They don't. Some of the worst decisions come from a far more humiliating source. Your nervous system is bored by stability. Calm markets feel empty. Slow growth feels unreal. Predictability feels like nothing is happening. So the mind starts hunting for movement. Not because movement is profitable, because movement feels alive. And this is where money stops being a tool and becomes emotional theater. Your brain was not designed to build wealth. It was designed to detect disturbance. For most of human history, stillness did not mean prosperity. It meant vulnerability. You listened for the branch that snapped. You scanned the horizon for the thing that changed shape. Your survival depended on noticing disruption before everyone else did. That wiring never left. It simply migrated. Now the rustle in the bushes has become a flashing chart, a breaking headline, a red candle, a sudden squeeze, a collapse everyone is suddenly watching closely. And the strange part is this: most people do not feel safest when markets are calm. They feel safest when they are emotionally engaged, because calm gives the mind nothing to grip. No enemy, no chase, no urgency, no role to play. So it begins manufacturing significance. A normal dip becomes a signal. A routine rally becomes a revelation. A random price move becomes a story about destiny, timing, or intelligence. This is why intelligent people overtrade, not because they lack information, because silence is psychologically intolerable. A portfolio quietly compounding in the dark does not stimulate the ancient brain, but chaos does. Chaos feels important. Chaos feels earned. Chaos feels like participation. And once the mind learns that financial intensity can relieve inner numbness, it stops looking at markets objectively. It starts using them chemically. But boredom is only the entry point. Because after the brain learns to crave volatility, it begins to crave something even more dangerous: an audience. Money is never just private. Even when nobody sees your account, they can still see your posture, your certainty, your predictions, your confidence during a rally, your composure during a crash. And human beings are exquisitely sensitive to status under uncertainty. In older environments, moments of danger reorganize the tribe. Who saw the threat first? Who stayed calm? Who became worth following? The modern market recreates that hierarchy every day. Suddenly, everyone wants to be the one who called it, the one who saw the bubble, the one who bought before the stampede, the one who remained unshaken while others panicked. So financial drama becomes more than stimulation. It becomes social positioning. A calm, disciplined investor often looks invisible. There is nothing cinematic about restraint, nothing tribal about patience, nothing seductive about saying, "I did almost nothing and that was the point." But a dramatic investor has presence.
They have narratives, warnings, conviction, battle scars, near misses, spectacular entries, spectacular reversals. Even failure can become status if it is theatrical enough. That is why crowds do not merely spread information, they spread emotional permission. A crowd allows you to panic with dignity, to chase with company, to collapse without feeling individually foolish. And this is where it turns dangerous. Because once financial behavior becomes social, the ego quietly steps in. It no longer wants returns. It wants to protect the image of being the kind of person who understands what is happening. And when money becomes fused with image, people stop defending capital, they start defending identity. Most people think they hate losing money. That is only partly true. They hate what the loss says about them. A loss is not just subtraction, it is insult, it is contradiction, it is an attack on the private fantasy that you are perceptive, rational, unusually difficult to fool, so the mind does something subtle. It converts financial pain into emotional meaning. Now, the position is no longer just a position. It becomes proof of loyalty, proof of conviction, proof that you can withstand what weaker people cannot. This is why some investors stay with bad decisions long after the evidence has rotted, not because the thesis still holds, because abandoning it would feel like self-erasure. The pain becomes part of the identity. And pain has a strange psychological advantage. It feels serious. Quiet gains can feel suspiciously easy. Steady progress can feel emotionally thin. But suffering feels profound. Suffering feels like depth. Suffering allows the ego to say, "You don't understand. I've been through this trade." So people begin confusing intensity with legitimacy. They trust the decision that cost them sleep. They romanticize the investment that nearly broke them. They remember the emotional violence more vividly than the actual probabilities. Here's what your brain doesn't tell you. Sometimes you are not holding because you believe in the asset. Sometimes you are holding because the pain has become your justification for staying. And once suffering starts to feel meaningful, the mind becomes vulnerable to an even darker pattern. It starts recreating instability on purpose, not consciously, but faithfully. There are people who say they want peace with money. What they often mean is they want peace without losing the emotional identity built inside chaos. That rarely works, because if your inner world is organized around tension, uncertainty starts to feel familiar, and familiarity is one of the most powerful drugs in human psychology. A stable financial life can feel sterile to a person whose nervous system was trained on emotional turbulence, so they do something strange. They move toward what disturbs them. They chase overheated stories. They re-enter after being burned. They abandon simple systems for dramatic ones. They trade not to express discipline, but to recreate the internal rhythm they already know. Anticipation, surge, fear, collapse, recovery fantasy. This is why some people do not merely make bad financial decisions. They build recurring emotional plots. The comeback, the vindication, the crash that proved they were almost right, the big swing that will redeem every smaller humiliation. Money becomes the stage where unresolved psychological needs dress up a strategy. At that point, the market is no longer the real subject. The self is. And the self does not always want wealth. Sometimes it wants stimulation. Sometimes it wants punishment. Sometimes it wants a dramatic explanation for a quiet emptiness it cannot name. That is why boring gains often get abandoned. They do not flatter the personality. They do not create a story. They do not let the ego feel exceptional. But dramatic losses do. They make you the hero of an internal movie, and the market is full of people confusing that movie with reality.
So, the real danger is not that markets are volatile. The real danger is that volatility can feel emotionally correct. That is the trap. You think you are managing money. You think you are evaluating risk. You think you are reacting to information. But beneath all of that, something older may be happening. Your brain may be using finance the way other people use conflict, obsession, or chaos to feel engaged with life. And if that's true, then your worst decisions were never purely financial. They were psychological cravings wearing financial language. The market does not need to destroy you. It only needs to offer your nervous system a familiar kind of drama. And most people will call that instinct conviction right until it empties them. Because sometimes, the most expensive thing in your portfolio is not the asset you bought. It is the version of yourself you keep trying to feel.